So we'll be going over IRS Form 461, limitation on excess business losses. So at the time of this recording, this is the most recent version of this form, the 2023 tax year. We are expecting the 2024 version to come out shortly. We'll get to the primary differences later on in this video. So what we're going to do is we're going to go over how to complete this form and the source information where it goes. You can see a lot of references to Schedule 1, so we're going to break down where you would get each of those pieces of information, and then how it applies to your tax return, and then we're going to go over some key concepts that you may need to understand. So let's go over the form. In this case, we've got our hero, John Doe. He is filing this form, and it's 1 page long. You can see that it's not even really 1 page. It's broken down into 3 parts. So there's total income and loss items. Then there's the adjustment for any amounts that are not attributable to a trade or a business. And then finally, we have the excess business loss limitation calculation. So for simplicity's sake, we've entered a lot of this information, but the numbers don't really matter as much as where they come from, so they're all the same. So we've entered line items of $100,000 as a loss, entered as negative numbers, indicating that they're losses. So for each of these forms, that way we can just focus on each line and where you're going to get this information for your tax return. So for those of you who use tax preparation software, this should be automatically imported from your these parts of your tax return. But for those of you who are doing this manually or just want a better understanding, we'll go through this in detail. So line 1 is reserved for future use. We're going to skip down to line 2. So the amount from Schedule 1 on your Form 1040, line 3, this is business income or loss as reported on Schedule C. So let's imagine that John Doe completed his Schedule C and reports $100,000 of a loss from his business. So we put that right here. Line 3, enter the amount from your Form 1040 or your Form 1040 SR. Line 7, these are capital gains, or in this case, capital losses from Schedule D and or IRS Form 8949, which is a form that helps break down capital gains and capital loss calculations for Schedule D purposes. So as a quick reminder, what I usually do is I will put in the show notes not only links to the article where we go into much more detail on some of these concepts. If they're not covered adequately in the video, you can use the article to drill down. I'll also put links in the show notes to resources that we've created for any of the forms and schedules mentioned here. So you can take notes if you want, but just know that whenever I mention a form or a schedule, we'll put links in the show notes so you can dig down for more information. All right, back to the form. So in line 4, we're going to enter the line 4 amount from Schedule 1. This is basically gains and losses from the sales or disposition of business property specifically. So you would find that on IRS Form 4797. So you may have a situation where you've sold personal assets or some sort of assets on Schedule D, and then the business portion of that would be reported separately on Form 4797. Line 5, this is your Schedule E income or loss. So residential or like rental real estate, royalties, partnerships, S corporation income. So anything that's reported to you on a K1 generally from those sources, you would be completing Schedule E, and then this trickles down into line 5. And then line 6, that would be Schedule F income for farm-related income or loss. And poor John Doe has suffered a $100,000 loss exactly from each of those 5 different activities. In line 7, this is reserved for future use. And then in line 8 is any other income, gain, or losses from a trade or a business that wasn't previously reported on lines 1 through 7. Taking a quick look at the form instructions, I can't really think of too much that that would fall into this category, and there's no specific reference in the form instructions. But if for some reason you have an item of income or gain or loss that's not reported on one of these forms or schedules, you would enter it here in line 8. And of course, that happened to John Doe as well. So he combines all of these, and he has $600,000 of total loss. Now in part 2, we're going to make an adjustment for any of these amounts that are not attributable to a trade or a business. So right now, this is just everything. And we don't know whether or not that was personal or not. So in part 2, we're going to strip out the stuff that wasn't attributable to a trade or a business. So first, in line 10, we're going to enter any income or gain that was reported on lines 1 through 8 that wasn't attributable to a trade or a business. And since they're all losses, there's no gains here to be reported. So that's a big 0. Line 11, we're going to take out the $100,000 of Schedule D income, or loss. So we'll just call that right here. We'll just say that that was personal assets and not necessarily anything to do with his trade or business. So that's $100,000 here. We're going to subtract the difference, and now there's a minus $100,000. Now, in part 3, we're going to apply the excess business loss limitation rules. So first thing that we need to do is strip out that trade or business related loss. And in line 13, we're going to flip the positive/negative sign on this. So since we reported this as a loss, we're going to turn it into a positive number. If this was a $100,000 gain, we would be turning that into a negative number. And then once we've got the proper plus minus sign in front of this number, we're going to combine that with the line or the part 1 total from line 9. So we've got minus $500,000. And now we're going to apply the current year excess business loss limitation, and I'll kind of go over this in just a second. So $289,000 is for anyone that's not married filing a joint return. Primarily single, that's what the form instructions are. But the way I read this form is that if you're a head of household, if you're married filing separately, I don't see any other limitations or determinations that would make this a different number. So in one case, let's just imagine that John Doe is married filing jointly, wrong number. If he's married filing jointly, he enters the 578 number, and he adds the $500,000 and the 578, and that ends up becoming $78,000. So according to this, because this business loss is less than the annual limitation, you don't even need to attach the form to your tax return. So John Doe, as a married filing jointly taxpayer, would not even need to complete this form because all of his losses that are reporting are below the limitation on business losses. Now, let's flip the script right here and imagine that he's doing this as a single taxpayer, in which case we're applying the $289,000 limitation, and we come up with a difference of negative $211,000. So the first thing that he would do is enter this as a positive number on Schedule 1, and we're going to go right here to Schedule 1, line 8P, and this is going to be a positive number that he uses as an adjustment, and that would be $211,000 for a single taxpayer. And the reason why is because he's already reporting all of these losses elsewhere, and this $210,000 is an adjustment for the current year tax return, so that he doesn't take the full scope of those limitations. And according to the IRS instructions, this $210,000 can be used for John Doe under normal circumstances in a very similar manner as net operating loss. So for people that are not in the farming profession business, this would be a carry forward to future tax years. Farmers have special rules that apply. You have to apply this excess business limit to your current year tax return, but you do have the option of being able to carry this back as a net operating loss to up to 2 tax years before you treat it as a carry forward. So if you had income that was reported, you can go back, amend your prior year tax return to apply this as a business loss before you carry forward. The IRS instructions also tell people that it is their responsibility to keep track of their excess business losses on their own, because it's not very obvious. Like there's no placeholder that they can rely upon to carry this forward to future tax years. So be sure to keep track of any amounts that you have to apply in line 8P of your Schedule 1. So let's go back to our form 461. And basically that's what we're talking about with this negative $211,000. So this is for the 2023 tax year. There have been a lot of people that were impacted by natural disasters that have an extension on their 2023 tax returns. So I'm providing this information on this form here. I expect that the 2024 version will look very similar, with the key difference of this limitation right here. So for the 2024 tax year, the $289,000 number is adjusted for inflation and is $305,000. And then the married filing jointly amount is $610,000. For tax year 2025, which the IRS recently released those numbers are $313,000 and $626,000 respectively. So all of this information is in our article. If you care to write it down, that's fine, but you can also pull this information from our article. The last key note is that there are ordering rules that apply. So in the form instructions, if you have anything to do with at-risk limitations, those are applied first. So the at-risk rules basically mean that if a certain amount of your investment is guaranteed or protected against loss, then you're really not at risk for that portion of your money. And let's just say that you invested 50% of your own money into a business, but then the other 50% was backed by a partner through an arrangement where they just gave you the money and would make you whole if the business doesn't work out. Then you would have to apply the at-risk rule limitations before you can do this. And then for passive activities, those passive activity loss limitations are also done before you apply the excess business loss limitations. So as I mentioned, we'll put links in the show notes to all the forms that were mentioned here, including the at-risk and the passive activity loss rules for future reference. So if you want to drill down into more detail or in the mechanics of this, you can check out our article. So you can either click the link in the show notes, or you can go to teachmepersonalfinance.com, type in IRS Form 461, and you'll see this article here. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, or if there's another topic that you'd like to see covered in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.